Welcome to a riveting lesson on how we do the accounting for purchases of merchandise. So if you're a merchandiser like Walmart, Target, or in your textbook, Z-Mart, in order to sell items to your customer, you've got to buy them in the first place. So the next couple of minutes, we're going to focus on the accounting for the purchases of merchandise to get them in our store. And then in the next tutorial, we'll focus more on the accounting for the sales of merchandise to our end customer. So here's our example from our textbook. We've got Z-Mart. And let's just say on November 2nd, Z-Mart records a $500 cash purchase of merchandise from its vendor. Well, this one should be fairly easy. When we do the journal entry on November 2nd, we have the current asset merchandise inventory increasing on the debit side, and cash goes down on the credit side for a cash purchase of merchandise. Now, one thing I'll be showing you is the income statement and balance sheet effects of many of these transactions. So notice what happens here. Nothing impacts our net income, or nothing impacts our income statement. It's simply one asset goes up, merchandise inventory, and another asset goes down, cash. But oftentimes in real life, most business-to-business transactions are done on credit. So let's show you this example. It's now November 2nd. We still buy $500 worth of merchandise from our vendor, but this time we don't pay them cash right away. They will give us the items, but then they'll also send us an invoice. And an invoice is just a fancy name for a bill, because we're going to buy it now and pay for it later. So the transaction, the journal entry, is really very much similar to what you saw before, but notice we still debit merchandise inventory, but we credit accounts payable because we are buying these items on credit. Now, one thing you'll notice down here, it says, what's this? Purchased goods terms 210 and 30? What does that mean? Well, I'll get to that coming up in just a moment on the next slide. But when we purchase merchandise on account, again, the income statement is not impacted whatsoever. And in this case, assets go up, merchandise inventory, and our liabilities, our accounts payable, increases on the right side. But yeah, let's focus on this. What do we mean by 210 and 30? Well, up here in this super cool graphic, we showed you the vendor is going to send Z-Mart an invoice, a bill. So let's show you exactly what could be on that invoice that Z-Mart receives. So this is what an invoice might look like. I'm not going to go through like everything in detail, but I guess just going through the all of the different number circles. It looks like Trex is the vendor that sold us the items. It looks like they sold it to us on November 2nd. They sold it to Z-Mart, so it gives us our name and our address. The purchase order date, so it looks like we ordered them on October 30th, a day before Halloween, and it looks like they shipped it to us a couple days later. But this is what I want to zone in on right here, this number 5, the terms 210 and 30. What in the world? Well, listen very carefully here. The N30 just means that the net amount that Z-Mart owes Trek is due within 30 days. N/30 means, hey, you owe us within 30 days. But this right here means if we pay within 10 days, we get a 2% discount off of the invoice price. Let me say that one more time. 210 and 30 means that, hey, we've got to pay you within 30 days, but if we pay you within 10 days, we're going to get a 2% discount off of the invoice price. That's what those terms mean, and we'll revisit that coming up in a second. Looks like the shipping cost is paid by the seller, Trex in this example, by Federal Express. It shows what we bought from them, the quantity, the price, and the grand total amount that we owe them, $500. So this is what an invoice might look like in the real world as far as all the different pieces of information on that invoice. Okay, so let's just say that, for example, if we go back to here, let's say we do pay within 10 days and we get 2% discount on the purchase price. Let's show you how we do the journal entry for that one. So now it's November 12th, it's 10 days later, and now we are paying them within the 10-day discount period. Now remember, we owe $500, but if we pay within the discount period, we get a 2% off the price. So it looks like we get $10 is going to be knocked off the price of the toddler Challenger X7, and a boys girls, oh my gosh, Speed Demon. All right, so we pay them within the discount period. Watch what happens here. Notice that our accounts payable gets wiped out for the entire invoice price of $500. That gets wiped out. Our merchandise inventory just got cheaper. It got cheaper by $10 because we paid within the discount period. So we end up crediting merchandise inventory for $10. That's an asset going down on the credit side. And now we send them cash, not for $500, but for $490 because we paid within the discount period. So in these T accounts over here, our accounts payable, we owed $500. And even though we're not sending them a check for $500, we are satisfying our accounts payable. So that's why we have a debit to accounts payable, and it gets wiped out to zero. Merchandise inventory, really the final cost was $490 is what our inventory cost. So we have to credit inventory for $10. And then cash goes down with a credit of $490. So on our balance sheet, our assets decrease for cash and our inventory became $10 cheaper, and we wipe out our accounts payable. And notice this transaction has no impact on our profit. Nothing happens with revenues or expenses. Now let's just say we pay after the discount period. Now it's due within 30 days, otherwise they're going to be very upset with us. So let's say we pay the $500 within the 30 days, but after that 10-day discount period. So this one should be a fairly simple journal entry. We wipe out the accounts payable, and our cash goes down to $500. So we have this impact on our balance sheet. And again, nothing hits the income statement when we pay down merchandise we bought on credit. But this is what happens in the real world. Every once in a while, we get merchandise, and we don't like it. We return it. Or we might just keep it, and the vendor just reduces the price. Those are called purchases allowances and purchase returns. All right, so our vendor sends us merchandise. We purchase merchandise from our vendor, but then we might return the merchandise back to them. Maybe it was damaged. Maybe they're defective goods. Maybe they shipped us the wrong items, or maybe we just changed our mind and we're just returning it. So that's what a purchase return is. It's the merchandiser sending back to the vendor any merchandise we purchased that was damaged, defective, or otherwise we just don't want it anymore. And the vendor, what they might say is like, you know what, don't return the items to us. Just keep the items and we'll just like maybe only charge you half the price. That, my friends, is called a purchase allowance. The vendor is allowing Z-Mart to keep the items, but now they're going to reduce the price that they are going to charge us from that invoice. So let's show you examples of both of them. First, with a purchase allowance. The vendor sends Z-Mart some merchandise, and we say, wait a second, these are defective. And they say, you know what, keep the merchandise. Don't bring it back to us. We'll just knock $30 off the invoice price. So if that's the transaction on November 5th, accounts payable is decreased. They decrease $30 as far as how much we owe them. So our liability goes down with the debit, and our inventory becomes $30 cheaper. So inventory, the asset is decreased with a credit. So that's the impact on our balance sheet. Merchandise inventory goes down, our liabilities decrease, and nothing impacts the income statement. But what about a purchase return? This is really similar. So in this case, they send us the items, and let's say in this one, they ship us $250 worth of merchandise. So for Z-Mart, their merchandise goes up and their accounts payable goes up with the terms, hey, pay us within 60 days, but if you pay us within 10 days, we'll knock off 2% of the price. So, oh, there we go. We just posted it to our T accounts, that first transaction. Now we return some of the items. Not all of them, but we return some of the items because, again, they're defective or some other reason. So we returned $50 worth of the merchandise saying, hey, we don't want these anymore. Well, when we return the merchandise, accounts payable decreases and our merchandise inventory goes down because we are returning $50 worth of merchandise. So let's go ahead and take this entry and post it to our T accounts. Our liability goes down and our inventory goes down. Now, let's say we pay them within the discount period, June 1st to June 11th. That's within the 10 days. So take a look at this T account up here. We owed them $250, but then we returned $50 worth of goods. So right now we owe them $200. Well, we get a $4 discount. That's 2% of the $200 we owe them. So now in this last entry, because this balance should be $200, we wipe out the accounts payable. Merchandise inventory just got $4 cheaper because we took advantage of that discount, and we're going to send them a payment for $196. Let's go ahead and post that to our T accounts. Yep, there we go. We wipe out our liability. Our merchandise now cost us $196, and we paid cash $196 in that last entry. So just a note on shipping costs, if we are Z-Mart, if we are the buyer, and we have to pay for the shipping costs, that's going to increase the cost of our inventory. Just like if you buy something on Amazon and they charge you $5 shipping, the cost of that item just got more expensive to you by $5. So if we're the purchaser, and let's say Z-Mart had to pay, let's say $25 in shipping, that would be a debit to merchandise inventory. That increases the cost of our inventory. So it's not only the invoice price of $250, but the shipping cost of $25 as well. Now, if you're the seller, and we'll cover more of this in our next lesson, but if you're the seller and you're the vendor and you have to pay for shipping, we charge it to a delivery expense. And that delivery expense actually hits your income statement. So just a distinction, if you're the buyer and you have to pay for shipping, it increases the cost of your inventory. If you're the seller and you have to pay Federal Express or UPS the shipping, that ends up being a delivery expense on your income statement. So in the end for Z-Mart, let's take a look at how maybe some of their purchases throughout the entire year. At the very top would be the invoice cost of all of their purchases, $235,800. But then we subtract out any discounts we received because we paid within a certain discount period. Then we subtract out any returns of merchandise or allowances from our vendors. We add in any costs that we might have paid for shipping. And this gets us a very important number, our net cost of merchandise purchases. For you consumer behavior and marketplace studies majors, yes, I'm talking to you people right now, and if you ever work for Kohl's department store or another merchandiser, this is going to be big right here. What was really the net cost of your purchases after discounts, after returns, and factoring how much we had to pay for shipping? So in this video lesson, we focused on purchasing of merchandise. And when we come back for your next tutorial, we'll take on the flip side of it, where we show you the accounting for selling merchandise to our customers.